day to you all. This is once again our class on investment analysis and portfolio management. And this is lecture number 34, and we were talking about returns, and we were talking about risk, and we talked about portfolios, and we talked about portfolio theories. But before we go into those details, we talked about investment decisions. What investment decisions need to be taken while we're talking about investments? So we need to understand the underlying investment decisions and the trade-off between expected rate of returns and expected risk. Because risk is something of the future, uncertainty is the name of the game. We do not know what's lying in the future. So expected return is not usually the same as realized return. So we need to understand the risk. We need to understand that deciding with what amount of risk we can take, we need to understand we're talking about returns. So the risk-return trade-off can easily be seen as the iron stomach test. We need to understand the risk as being the possibility that the realized return will be different from expected return. Now, the important thing is these investment decisions are going to be the key to our making more money or less money. But this is going to be when we look at the risk factor. So the investment decision process can be talked about as a two-step process. One, talking about security analysis and valuation, in which you decide what necessary is there to understand about the characteristics of our portfolios, investment decision. Plus, we can talk about portfolio and portfolio management. So we talk about selected securities viewed as a single unit, because portfolio is all about being a singular unit or a basket of securities, and how efficient are financial markets in processing all the incoming information that we can collect and gather and filter and screen and decide what is good and what is bad. So how and when we can decide what sort of investment decision went wrong, we can swap into another investment decision and then measure the amounts of profits and measure the amounts of risk. So there are basic strategies that we need to look at. What are the basic strategies? We have basic decisions involved in fixed incomes, and we can talk about decisions being what? Active and passive. So we talk about active strategies in which we can expect superior returns from a fixed income security. In active investments, we look at better returns than passive investments. Now, we talked about superior returns. We talked about returns that will help us talk about interest rates. We talked about returns that we could look at mispriced from other factors, including factors that investors look at and identify bonds, finding whether they're underpriced or mispriced or overpriced. So we'll need to look at bonds that has a credit risk. We'll look at a bond having credit risk premiums. We have to look out at these. If we were looking at passive management, we can talk about bond index funds, meaning we can have a spread of bonds into a portfolio and then look at the averages, or we can look at the immunization of interest rate risk. We could look at the net worth immunization and making duration of assets equal to duration of liabilities. We're doing a balancing act between liabilities and assets. That's what a balance sheet is. That's what portfolio management is. That's what diversification is. We need to balance returns and we need to balance risk. We need to balance assets and we need to balance liabilities. So we look at the target date immunization. We look at the holding period matching returns on looking at the duration. Obviously, we're talking about cash flow matching with duration. Now, if we look at durations and cash flows, we need to understand immunization. We talked about contingent immunization. What is contingent immunization? Contingent immunization is about combinations of both active and passive management. That is what contingent immunization is. We include both the management styles. So we look at strategies that will help us manage portfolios on fixed income, and we'll have it in line with the floor rate of return, which would mean this is the bottom line where our return cannot be less than what we can expect. Plus, as long as rates exceed the floor, the portfolio is being managed actively. However, on the other hand, once flow rates are triggered, then portfolio is immunized, meaning that we will not be getting lesser returns than the flow rate. But there are factors that affect this process. One of them is uncertainty. Uncertainty is one of the most important factors that affects returns on investments. You look at uncertainty that dominates decision processes. Uncertainty is something that overrules everything. This is because future is unknown and it can only be estimated. It has to be. It must be estimated. That's the only thing we can do about the future. So foreign financial analysis, quick adjustments have to be done on whatever investments we are doing. Quick adjustments have to be done. What is a good investment? What is a bad investment? The internet and investment opportunities provided by them are other factors that we can explore when we're talking about investment. Also, we can look at institutional investors leading the way for individual investors, because institutional investors have a bigger way of making markets move. This is all about portfolio. This is all about returns. We talked about portfolio theories, and the investment decisions all come in the portfolio theories. It involves uncertainty. It involves focus on expected return. It involves estimates of future returns needed to consider and manage risk. Also, we look at the goal is to reduce risk without affecting returns. That is important. We must understand that this can be accomplished only by building a portfolio. And how do you build a portfolio? You build a portfolio by diversification. We're talking about diversification as the key to success, diversification as the key to minimize losses and enhance profits, balance profits and losses, or improve your chances of getting more profits and reducing losses. We're talking about dealing with the uncertainty. Uncertainty is the risk that an expected return will not be realized. We're talking about returns that these will be about single returns based on the portfolio that we are managing. These returns will definitely be about the entire portfolio and not about the single aspect of a share or an equity inside the portfolio. We can be discrete, we can be continuous. We should be looking at the probabilities that weight outcomes. We must understand that one single share cannot outdo the rest of the portfolio. That's not really possible. So we look at how we can calculate expected returns. While we're talking about calculating expected returns, we're talking about expected values. When we're talking about expected values, we're talking about the single most likely outcome from a particular probability distribution. We're talking about the weighted average of all possible return outcomes, or we're talking about this being referred to as an ex ante or expected return. Expected returns will be different than realized returns. So you'll have a confusion between your expected cash inflows than what will actually be shown onto your balance sheets. So if you look at expected returns in relationship to realized returns, that will be different. We need to calculate expected returns. We need to calculate the realized returns. So how do you calculate risk? We can talk about variance. We can talk about standard deviation. We can talk about variance and standard deviation used to quantify, used to measure risk. Variance and standard deviation are the two key components that will help you measure risk. They will help you quantify risk. The measures the spread in the probability distribution. So variance will help you do that. Standard deviation will help you do that. That is how you will understand risk when you look at the mean to variance and you look at the mean to standard deviation. So we understand that when you calculate risk, there is going to be a probability that you'll find that the standard deviation is going to be, more volatile, because we're talking about volatility in the prices. We're talking about volatility and minimizing volatility through portfolio management. When we're talking about returns, when talking about expected returns, we're talking about expected returns on a portfolio. How do we do that? Do that by looking at the weighted average of the individual security expected returns and then add them all up to find out the cumulative return of a portfolio. We also look at that each portfolio asset has a weight. Obviously, we're talking about an entire basket, but we do understand that each product inside that portfolio asset, own credibility, its own worth, its own return ability of creating wealth for the investor. Although we look at the portfolio as a complete one unit, but you cannot ignore every product's inclusion into the portfolio of being of value or not. It is very important. In fact, all the goodnesses of individuals make one big goodness. And we do not say that individual scripts will outweigh the entire portfolio. No, they will not, but it will affect the earnings as well. So you need to look at portfolio risk simply as the sum of individual security risk. It's not like that. Portfolio risk emphasizes on the risk of the entire portfolio. It's more important to look at the portfolio as a whole and not as individual scripts. We talk about portfolios, the reason is that we are able to diversify risk on individual securities. So individual stocks are risky only if they add risk to the portfolio. Really bad scripts, you don't want to get anywhere near them, but once in a while you can make a wrong investment decision, but that does not mean that the entire portfolio is going to get infected. Yes, it is going to affect, because there are certain rules of the thumb when making portfolio. You don't put in one big thing into the portfolio outweighing the rest of the things. There's a certain percentage that you need to follow. So you need to talk about portfolio risk by measuring it, measured by variance or measured by standard deviation. You measure variance or standard deviation of the portfolio's return. Now, when we talk about portfolio's return, when we're talking about standard deviation, we're talking about variance, we're talking about portfolio risk, and portfolio risk is not a weighted average. Portfolio risk is not a weighted average of the risk of the individual securities in the portfolio. Risk is of the entire portfolio, because that's why we designed a portfolio. If you are looking at individual securities and the risk related to them, there's no fun in creating a portfolio. We're diversifying all this. Talking about risk reduction in portfolios. When talking about risk reductions in portfolios, what are we talking all about? We're talking about assuming all risk sources for a portfolio of securities are independent. We're talking about the larger the number of securities, the smaller the exposure to any particular risk. What is this? Insurance principle. This is an insurance principle related, it's not about insurance, it's an insurance principle related to portfolio management, in which the larger the number of securities, the smaller the exposure to any particular risk. Very simple, nothing to be confused of. Only issue is how many securities. How many securities is the problem to look at when you're building up a portfolio. What is this numbers game? We know single security is going to be the most dicey. Since we've noticed that single security investments are going to be risky, we decide to build up a portfolio. To build up a portfolio, we need more than one script. So what do? You add in a lot of scripts into the portfolio and diversify risk, which means you're also diversifying profits as well. In doing that, what is to be understood is that you need to understand that portfolio is about diversifying and putting a number of companies into the basket. Now, I said it before, I'll say it again, how many? We do understand the insurance principle by now, in which more the number of companies involved in the portfolio, lesser the risk, lesser the exposure to one single company. Because if you have 100% and you have 20 scripts in it, it would mean you have maybe 5% weightage to any particular script. You'll have a 5% risk factor on each script. If you have 10 in the portfolio, that would mean giving a weightage of 10% to any single script. The lesser the number, the more the risk factor. So if you have 5, you'll have a 20% risk in one script, which is really a great risk. So you need to understand, how are we going to do a balancing act? How are we going to do the best job for the work done for us is that we put on only find out numbers that you can use in a portfolio. How do you do that? Risk reduction. You do that through risk reduction of portfolios. Try to reduce risk in portfolios. We do that by diversification, fine. But what sort of diversification are we talking about? We're talking about diversification, random in nature. Being graduate students, we do understand what randomness is. We're not talking about random walk theories. We're talking about random diversification. You pick a number of scripts and include it in the portfolio. You look towards diversifying without looking at relevant investment characteristics. Not a very good way, though. You're not talking about valuations, not talking about fundamental analysis, maybe not even talking about technical analysis, but randomly picking out investments for the portfolio. And that is what randomness of diversification is. Of course, random activity will give you marginal risk reduction, getting smaller and smaller as more and more companies or more and more securities are added. We talked about this a little while ago as well. But a large number of securities is not required for any significant risk reduction. It's nothing actually to do with the number of, you put in 100 companies in the portfolio would mean the number of risks are reduced? No. You do not achieve anything by increasing numbers in a portfolio. Rather, it's going to be difficult to manage such a great number. It won't serve the purpose as well. Also, international diversification benefits sometimes. But let's look at the local environment. Let's try to understand that randomness is probably not as good as we would want it to be. Can we then name it that dartboard method? You just figure out, okay, I'll buy. You like the names and you'll figure out what to buy and leave out what you don't want to buy. It's not really a very, very mature way of deciding what to build up a portfolio of. Randomness is, yes, a word, but maybe not as exciting in portfolio management. It will let you diversify through the dartboard method, but it will really not help you. If you look at the diagram on your screens, if you look at this figure on your screens, you will understand a little bit more about portfolio risk and diversification. I mean, you'll notice a marked relationship between portfolio risk and market risk. And we understand lesser the number of securities in portfolio, more the risk. More you increase the number of securities in the portfolio, lesser the risk. Eventually, your portfolio risk will become in line with the market risk if you put in as many market risk companies into the portfolio. Meaning, if you have one share, you get the highest risk level. If you put in 100 shares in your portfolio, you get market average risk. But that doesn't solve the purpose. It just saves you from unnecessary risk, but then hopefully will always give you average returns as well. When we talked about portfolio theory, we talked about reducing risk, but not affecting the returns. If you enhance the number of companies in the portfolio, you'll just be doing that. And we don't want that to happen to our portfolio. Our portfolio is supposed to be doing better than getting a return equal to just the floor rate of return. That would mean having an optimal portfolio. having the best numbers. It's not about numbers. It's not about market capitalization. It's not about liquidity. It's about having the right decision. Ignore random diversification. We can talk about Markowitz diversification maybe. It's all about randomness. But in Markowitz diversification, it's non-random diversification. Obviously, it's the absolute opposite of random diversification. Markowitz tells us what? It is an active measurement and management of portfolio risk, a much, much better way to manage risk and manage a portfolio. Markowitz tells us about investigating relationships between portfolio securities before making a decision to invest. Markowitz diversification takes advantage of expected returns and risk for individual securities and how security returns move together. Industry will be the same. Securities in the industry will tend to toe the line of industry leaders, and the tendency of securities is to maybe have the same sort of returns than any other as compared to the sector. We talked about a number of things in valuation. We talked about the EIC analysis, and you do relative comparison of investments. And you do that by comparing companies from the same industry, or maybe companies doing the same business, or companies with the same market capitalization. We compare them, and then you can find out a better company of the two. So we take advantage of this Markowitz diversification, in which you do active measurement and management of portfolio risk, and you investigate relationships between portfolio securities before you actually make a decision to take a risk. Now, you take advantage. You take advantage of this knowledge. You take advantage of expected return. You take advantage of the expected return and risk for individual securities and how security returns move together. That is the difference between random diversification and non-random diversification. Markowitz theory helps us do that. How do you measure portfolio risk under Markowitz? You need to be measuring portfolio risk as well. In doing that, we need to understand that it's needed to calculate. Why do we need it, in fact? We need it to calculate risk of a portfolio. You don't simply get investment decisions and hold on to it and go on a holiday. You have to manage that portfolio and manage the risk as well, because you know, to be held responsible for the investment decision, because you're looking after people's money as well. Even if it's your own money, you're accountable to what decisions you made. No point when you cry over spilt milk, you do damage control. You do crisis management before the crisis arises. You do that by calculating risk of the portfolio before you make an investment decision, not after. You think before you leap. You do the homework before. You do your homework before there is an exam, not after. You do this by looking at non-random portfolio management and risk management, and you look at the weighted individual security risk. You have to look at the individual securities as well. So you calculate a weighted variance using the proportion of funds in each security. You have to allocate. You have to decide how much funds you need to put into one security and then use it as a total in the basket of securities. So weighted co-movements between returns. You look at the weighted movements between returns. You look at the return covariances are weighted using the proportion of funds in each security. You can talk about rupees. You can talk about, we normally talk about that in terms of dollars or rupee averaging. We do not talk about numbers of shares in a portfolio. We talk it about it in rupee terms, in dollar terms. You do not put in shares of a company priced as rupees 350 at the same level of a company of shares of rupees 20, which would mean you can't put in 100,000 shares of company A priced rupees 20 along with 100,000 shares of company B priced as rupees 350. That would be suicide. You don't do that. You talk about numbers. You allocate rupees or dollars. You talk about the number of rupees that you're going to allocate to a particular company. And that's how you diversify. You may have a balance. You may have more scripts of one company and less of another. That's acceptable. But there are rules that you need to follow. The rules you need to follow, like, let's talk about correlation coefficient. Correlation coefficient is a statistical measure of association. You need to talk about averages. You need to talk about measuring the association of different scripts. There has to be a correlation coefficient between securities, A or B, M or N, X or Y. You need to understand there has to be a relationship or a correlationship, maybe perfectly negative, inverse, or zero correlation. It all depends on what sort of companies are we looking at. There'll be growth companies. When you're building up portfolios, we're talking about portfolio management as in maybe value investing or growth investing or a blend of growth investments and value investments together. We need to balance an act. We need to balance the portfolio. You may not have all sorts of one company, value companies, or one sort of growth company in the portfolio. A blend would do better justification if you are making a good decision. If we are having balanced portfolio, we must allocate to growth companies, we must allocate to value companies, we must talk about active management, we must talk about passive management, we must talk about equities, bonds, money market, foreign exchange, ready cash or near cash to diversify the portfolio and spread the risk, minimize the risk, yet not affect the expected returns. In doing that, we have to follow the principle of looking at the non-random way of selecting a portfolio in not giving too much weightage to one particular company or not too much weightage to one particular sector. Because when we talked about companies following in the sector, they'll tend to match each other's ability to rise or fall. Although they'll have their own earning capacities, they tend to be overshadowed by the big brothers in the sector. If we're looking at sectors, we need to understand that sometimes it's not a good idea to have companies from the same sector inside, except when you're having a sectoral specific portfolio. But right now we're not talking about sectoral specific portfolios. We're talking about proper diversified portfolio. We talked about correlation coefficient. When does diversification actually pay back? Does it really do you any good? How do you come to know about that? Well, it's when you look at paybacks with perfectly positive correlated securities. Maybe risk is a weighted average. We talked about this. Risk is a weighted average, and we're talking about weighted average as in portfolio terms, not an individual script. So risk is a weighted average in a portfolio, plus, therefore, there is no risk reduction. Even when the correlation coefficient risk is already a weighted average. We're talking about the basket. So, with zero correlation securities or with perfectly negative correlated securities, we need to understand whether we're talking about positive correlated correlations or negative correlated correlations or zero correlated companies, securities. We need to find out, because risk is not related to one. When we're talking about portfolios, we're talking about the correlation in relationship to the entire portfolio. That is why we need to understand this. Then we need to understand covariance. Covariance is the absolute measure of association. How does this help us building a portfolio? How does correlation or covariance help us build the portfolio and decide what to invest in, what securities to avoid? Now, covariance is not limited to values. And what sort of values are there? Values between -1 and values between +1, and we can find out what scripts are lying between these -1 and +1 values. This sign is interpreted the same as correlation. So, correlation coefficient and covariance are related through the following equation. Have a look at the equation, work it out, and you'll be able to find out how this correlation coefficient and covariance works out and relates in the following equation, which is now appearing on your screen. Since portfolio risks have to be measured, since portfolio returns have also to be assessed, we need to be doing this all on estimates or calculating future expectations. Being different from realized returns is not something that we've not talked about before, but portfolio theories, Markowitz non-random selection process or risk theory, and finding out which are the best scripts based on not randomness but based on some factual valuation assessment, and then not assigning too much weightage or giving too much room to one particular script than other scripts, balancing the act, talking about passive and active management, and then talking about value investing and growth investing will make you really do well in talking about portfolio management and selecting scripts to be included into the portfolio management, and especially because when doing this, we're not worried about risk in a way that would be associated as risk for a single company, because this risk is a weighted average in the entire basket. Now, we look at calculating portfolio risk by encompassing three factors. We look at three factors involved in calculating portfolio risk. These are variance or risk of each security, the risk of security, each security in the portfolio. Factors like covariance between each pair of securities or portfolio weights for each security. These are the three risk factors that are going to make or break a portfolio or an asset manager. You need to do your homework on variance of each security, on covariance between each pair of security, and the weightage of the security in the portfolio. If you get these things right, there's nothing that can stop you from doing well in a portfolio. Now, the goal. What is the goal in calculating portfolios, calculating the risk, looking at the three factors that I just mentioned you? What is the goal? The goal is to select weights to determine the minimum variance combination for a given level of expected return. You have to determine what sort of levels you're going to get into when you're talking about securities inside a portfolio. And the three most significant factors that you need to look at would be variance of each security, covariance between each pair of securities, and the weight for each security in the portfolio. Then only you'll be spreading risk, then only you'll be calculating portfolio risk, and then only you'll be able to get the best returns on your investments by looking and encompassing these three factors into the portfolio. What about generalizations in calculating portfolio risk? Generalization, a term used in genetics, generalized, macro. Generalizations would mean the smaller and positive correlation between securities, the better. Also, covariance calculations grow quickly, and as the number of security increases, the importance of covariance relationships increases as well. More the companies in the portfolio, greater the importance of covariance relationship increases. Also, the importance of each individual securities risk decreases. More the shares, more the companies, lesser the risk. Lesser the companies, lesser the equities, more the risk. The relationship that you have to look at. But we talked that 100 companies in a portfolio will not do you as much good as maybe 20 companies into a portfolio. On the other hand, reducing the number will significantly increase the risk in the portfolio. So we look at the three things that we talked about: the weightage of each script in the portfolio, and the risk of each security, and the covariance of pairs of securities have to be understood if we are to be talking about better results in portfolios and lesser risk in portfolios, because this will help you understand when you're talking about the increase in number and the relationship in risk, decreasing risk. So the importance of each individual security risk decreases as numbers increase, and vice versa. So we need to understand the generalization that the smaller the positive correlation between securities, the better for calculating portfolios and assessing the risk factors associated with portfolios. But the more you diversify, the more homework you have to do. Since you put these securities into the portfolios, there's some sort of active management that you need to be doing on a number of companies. The reason why we give our funds to a fund manager or a money manager or an asset manager is we really can't do this work by ourselves. We need to be professionally and academically be sound to understand the procedures and the intricacies of building a really wonderful portfolio. So if we were to be simplifying Markowitz calculations, we would understand that Markowitz full covariance model. Theory of Markowitz is a portfolio theory, so we need to follow the Markowitz full covariance model. And this requires a covariance between the returns and the returns of all the securities in order to calculate portfolio variance. Very simple. Markowitz full covariance model makes you understand that it requires a covariance between the returns of all securities in order to calculate portfolio variance. Actually, nothing to be surprised about, because if we need to assess portfolios covariance, obviously you need to have the individual covariance of each security as well. We need to understand, because Markowitz suggests using an index to which all securities are related to simplify. A benchmark, a mean, a base, which you could relate to with the performance of each company. Maybe you can have an average, a weighted average, based on all the companies' returns, and find out what average is, what companies are ahead of the average, and what companies are below the average or the benchmark or the mean. So Markowitz really suggests something good. You should be able to use an index as a benchmark or an index to which all securities are related to simplify. The benchmark is the key word. You have to have a benchmark by which you can calculate the earnings or the performance of the individual scripts in a portfolio and the portfolio as a whole. When we talk about strategic management, when we talk about portfolio management, we need to understand it in relationship to strategic management as well, in which you formulate a strategy, you plan a strategy, you formulate a strategy, you implement the strategy, and then you evaluate the strategy. What do we do in portfolios? we plan a portfolio, we formulate a portfolio, we invest in the portfolio, and obviously in doing that, why do we do that? It's no fun. We need to evaluate the performance as well. So, what Markowitz was trying to tell us all is that we need to have an index by which we are able to relate what the performances have been of an individual company or the portfolios as well as a total. So then, what is an efficient portfolio? How do we look at the best possible portfolio? What would be a better portfolio than another portfolio? One of the ways to look at and find an efficient portfolio is to look at the smallest portfolio risk for a given level of expected returns. That makes sense that we were looking at portfolios with the least portfolio risk, smallest portfolio risk for a given level of expected return. We will always use the word expected return, expected risk, because we're talking about the future. And future is unobservable and future is uncertain. And since there is uncertainty in investments, there is uncertainty in the future, you'll always use the term expected, be it risk, be it return. Now, looking at an efficient portfolio, largest expected returns for a given level of portfolio risk, or maybe the smallest portfolio risk for a given level of portfolio return, expected return, you have to look at the switching over of the terms, smallest portfolio risk, largest expected return. We talked about from the set of all possible portfolios. Only locate and analyze the subset known as the efficient set, which means lowest risk for given level of return. We're not talking about smallest portfolio risk. We're not talking about largest expected return. We're not talking about smallest portfolio risk for a given level of expected return. We're not talking about largest expected returns for a given level of portfolio risk. We're talking about lowest risk for a given level of returns. Trying to find a balancing, do a balancing act. We're trying to be on a trapeze. We're trying to walk the rope, and we have no nets to break our falls. We have to find out an efficient portfolio. We need to find out whether all other portfolios in attainable set are dominated by efficient sets. That is one thing that you must understand. We need to find out in comparison with all other portfolios. And then all other portfolios in attainable set are dominated by efficient sets. Also, we need to look at global minimum variance portfolios. If we were talking about international investments, we need to talk about global minimum variance portfolio. We need to talk about smallest risk of the efficient set of portfolios. We need to talk about efficient sets. Talking about an efficient portfolio, therefore we need to talk about an efficient set. And it is a part of the efficient frontier with greater risk than the global minimum variance portfolio. Don't get confused. We talk about of minimizing risk. We're talking about making the portfolio efficient. We're talking about best portfolios, and we're talking about efficient portfolios. We talked about what a good portfolio would be. Portfolio with lesser risk, more returns, or a portfolio with lesser returns, more risk, or a portfolio with average returns and average risk, or a portfolio with very good returns and reasonable risk. And that is why we were shoved into talking about efficient portfolios. Efficiency. An efficient portfolio is a better way of handling assets. We need to understand efficiency. We took time talking about portfolio risks. We took time talking about returns on portfolios. We took time on all the different aspects of investments in portfolios, but we need to understand that we need to compare efficient portfolios as compared with global investment procedures. In doing that, we need to find that it is the efficient set which is part of the efficient frontier with greater risk than the global minimum variance portfolio, which would give you the best results, which will give you a diversified risk and will be minimizing risk in the process as well. Which leads us to what sort of portfolio are then you going to be making or looking at? Then we need to understand portfolio selection. We talked about portfolio theories. We talked about portfolio management. We talked about efficient portfolios. But how do you do that? You do that by portfolio selection. In doing portfolio selection, we must understand that diversification is the key to optimal risk management. Portfolios will never ever be successful unless you're successful in managing risk. Profits is all about managing risk, not profits is all about managing monies. It's not about managing funds, it's about managing risk. You minimize risk, you'll be automatically be maximizing returns as well. It's not the funds that you need to look at, it's the risk factor with the funds that you need to look at. So you need to have a good portfolio selection, which leads us to what? Diversification. The name keeps coming up whenever we talk about portfolios. Diversification is the key to optimal risk management. The good word is risk management. We're not reducing risk, we're not increasing risk, we are managing risk. Some things cannot be eliminated. They can only be managed. So you can manage them well or you can manage them badly. But you can just about manage them, not outdo, get away with risk. Risk is once again what you can never get rid of. The risk shall always be there, how you manage it. Challenges shall always be there, you'll always have to manage them. Problems will always be there, it's how you manage them. So analysis is required. Analysis is required because of the infinite number of portfolios of risky assets. That is one of the key components of portfolio selection. One was diversification, the second was analysis required. Analysis. Then, how should investors select the best risky portfolio? Why should a portfolio be risky? Well, all portfolios are risky to some extent. So what should be the best risky portfolio? And then, how could riskless assets be used? Why should a portfolio be risky when we can have a riskless portfolio? But then, we're talking about returns, substandard returns, or good returns. If we're talking about risk, we're talking about good returns. If we're talking about riskless returns, we're talking about peanuts. You're not going to get anything worth mentioning. You're not going to get anything beyond inflation. So why build up a portfolio at all? Why not put that money in a financial institution and just get a minimal return? We don't want that when we're talking about asset. We're talking about portfolios. We're talking about stock market, and stock market is a much better place to invest. A risky place, although, but a much better way to increase your wealth. Question arises, why do we need to get into the investment process to need a better, healthy future? You could do that by investing, or you could do that by saving. We've done a lot of talking on savings. We need to do a lot of talking on investments as well. And while we were talking about investments, we talked about investing where? Either investing it ourselves, for which we need to have above average qualifications. By qualifications, I don't need to say we're talking about the regular university education. We're talking about qualifications to understand the capital market, to understand the market, to be able to understand the balance sheets. And in doing that, we need to understand the risk factors involved in deciding whether to put your monies into one product, diversify the product, or hand it over to somebody else to manage it for you. And we found the best way to spread risk, minimize risk, is to build up a portfolio. And that's what we've been talking about in the previous lecture and this lecture as well, and maybe the next lecture as well too. So while we're talking about investing, we decided where to put our money in, and that was portfolio. So when we're talking about portfolios, we talked about portfolio and using a relatively, reasonably risky portfolio. And then we decided we do not want to get into a random selection in portfolios. We want to go into non-randomness of a portfolio, which led us to the word and the gentleman called Markowitz, whose portfolio theory tells us to go into for non-random selections. And when we talked about encompassing our decision-making process, we decided that 3 factors that are paramount in deciding what a portfolio would be good: diversification, finding out the levels of risk, deciding what securities to invest in, evaluating the investment process, and then trying to find out what would be the best fit for our portfolios with looking at the expected returns and then minimizing the risk as well. So we look at the best possible theory by looking at the 3 factors that revolve around the portfolio management and giving the best fit to one particular share, looking at the evaluations of these scripts that you look at, looking at the variance of individual scripts, covariance of sets of pairs of scripts, and the risk weightage of each script. And we get a good balanced portfolio. We can look at foreign investments, local investments, good returns, but you have to decide what sort of expected return are you really expecting. And then we found out that we cannot avoid risk. So we calculated risk in relationship covariance in relationship to standard deviation, by which we will be able to understand and calculate risk and find out what is going to be the best fit for our portfolio. And then we didn't forget to say something about value shares, growth shares, value investing and growth investing, or a blend of both, and then maybe diversifying not only to fixed income stocks or fixed income bonds. We were talking about investing also into variable return investments, maybe the money market, maybe the foreign exchange, and several other products, including derivatives, that you could include into the portfolio. But the bottom line result was that we found out from these couple of lectures was that we need to find out a considerably less riskier or a balanced risky profit relationship between a portfolio, so that we would be able to diversify our risk level but not affect our returns as well. That was one of the bottom lines about portfolios and managing the portfolios relatively in a risky business, but with better returns. That is what portfolio management is all about. It's about managing risk. It's not, once again, managing funds. You manage the risk, the fund will do the rest for you. We'll talk about the portfolio theory again in our coming lecture. Thank you very much.